A lot of people are making this simple mistake that could cost you thousands of dollars, and it's what separates good traders from great traders or investors in the stock market. We're talking about checklists. We're going to go over the basic checklist for determining good stocks based off of valuation, finances, the dividend, the growth rates, and making sure you know what it really means to invest in a stock and how long you should be investing into it and what to look out for when it comes to diversification of your portfolio. Make sure to hit that subscribe button and let's get started. So whether you're day trading, making some swing trades, getting into some long-term investments, these are things that you need to know and things that you need to check for every single time. You need to make sure that you don't have FOMO. You're not just jumping into a trade because you see other people doing it, because you think it's hyped up. You may have heard the term buy the rumor, sell the news. That is often the case with a lot of hyped things. Understanding your psychology and the emotions that go into trading is huge. That's why, I have that poster right there. Trade your plan, not your emotions. And when you have a big loss in the market or you have a big gain, that could also get to your head and make you feel like, hey, I can't lose, or hey, I can't win. And you probably don't want to trade when you've been fighting with your wife about something ridiculous for 10 hours. And as simple as those things may sound, I've done those things. It comes from experience. I'm sure other people can relate to this. So don't do it and keep your wife happy. This checklist is for investing, not necessarily short-term trading, which may have other rules and checklists that you may want to go through. For long-term investing, generally speaking, you want to be investing in those companies for at least a minimum of 1 year. You foresee holding those companies through thick and thin, whether they're going up or down, volatility in the short term, and you really see yourself as an owner of those companies. With that being said, you want to make sure that the money you're putting into those stocks is not money that you're about to take out within the next few months or maybe even weeks or days. That's not really investing. Let's get into the interesting stuff, the fundamental analysis. So valuation, is the stock undervalued or overvalued? That's $1 trillion question. Everyone's looking out for the next undervalued stock that's gonna go up massively. In terms of valuation, what I like to look for before investing into a particular stock, I wanna see how that company's PE ratio performs relative to the S&P 500, to its sector, and its peers. Trailing PE ratio is the price to earnings. So that's a measure of how much a company makes in terms of its net income relative to the number of shares it has outstanding, and then relative to the price of the stock. Trailing PE on the S&P 500 right now is around 20. And if your stock is maybe a PE of 15, that is undervalued relative to the overall market. Some sectors trade at higher valuations, higher multiples of its earnings than other companies. You don't want to compare Apple to a Citibank. You probably want to compare it to something like a Microsoft. In an ideal world, if stock A and stock B were exactly the same except for the valuations, one trades at a PE of 16 and one trades at a PE of 14, then stock B is more undervalued than stock A. So after the PE ratio, you want to next look at the forward PE ratio, which is a good way of determining what is the company's growth in the future in terms of its net income and how that relates to the valuation right now. For example, a company with a PE ratio of 20 could have a forward PE ratio of 15 or 12. That means all else being equal with the price, this company's earnings in the next year, the next 12 months, this estimate is, it's going to go up. You're getting a better deal. You're getting a company producing more earnings. And number 3, for valuation, you want to look at the price to earnings to growth. This is a ratio for looking at how the price of a stock compares to its expected earnings and in comparison to the growth rate of that company's earnings. There's a whole lot to go into valuation, but if you want just a quick, easy checklist, that's the 3 things that I would look at. Moving on to finances. Now, this is a very important thing for investments. You don't want to invest in a company that's going to go bankrupt. First thing that I look for is a debt to equity ratio under 2. This is a good rule of thumb for determining whether a company's debt is way too high. Balance sheet, are assets much higher than liabilities? What I like to do is look at the current ratio, which is current assets to current liabilities. Current liabilities are what the company really needs to pay off within the next 6, 12, 18 months. If it's 1.5, I would say that's good. And if it's 2, I would say that's great because you have twice the current assets to liabilities. It's just in a safer financial position. You'll find in a lot of recessionary times that we're experiencing right now, some companies do have a harder time raising money. Not only is it more expensive to take out debt when interest rates are rising, but also you have companies where they used to be able to issue a lot of shares onto the market and everyone's buying them. That's not happening. And finally, for finances, ideally you want to pick stocks that do have a positive cash flow. You can look at the cash flow statement. That's cash in, cash out. If you're going to invest in companies that are not cash flow positive, you kind of want to see a trend where the cash flow statement is getting better. It's not like they're losing more and more and more and more money over time. That's what I would look out for in a company's finances. By the way, if you're curious as to what apps I use to trade stocks and do some of this fundamental research, make sure to check out Moomoo. I have a referral link and you can get up to 10 free stocks. Now, related to finances is section 3, which is going to be dividends. Now, dividends, if a company has been cash flow positive for a long time, producing great net income, probably been around for decades, then it might have enough money to pay dividends. So dividends are cash payments that are credited to your account, usually every 3 months. They're paid quarterly. Some companies pay monthly. And this is, cash flow to you, the shareholder, because the company has so much money, it doesn't know what to do with it. Now, if you are investing for dividends, you want to make sure that the company has paid out those dividends for years to be safe. I like to say the last 5 years. And without any dividend cuts, without stopping any dividend payments. If you want to avoid a company that might do that, you want to make sure that they're in a essential business, consumer staples, utilities maybe, because everyone, even in a recession, still has to pay for those services or those goods. Lastly, is the payout ratio above industry average? There are some companies that pay almost all of their net income as dividends. What's the problem with that? If they're giving me all their money, I want that, right? But if a company is paying all of its income, if that income were to go down at some point because of, again, recession, precarious situation right there. On the other hand, if the payout ratio is maybe only 30%, they have a pretty good cushion to increase that dividend, or at the very least not cut that dividend. A general rule of thumb that I like to keep in mind is a payout ratio above 70 starts to get risky. Payout ratio under 30, generally not risky. If you're not investing in a stock for the dividends, you're probably investing for growth. When it comes to revenue or net income, you want to invest in a stock where you can see a consistent track record. Is that revenue an uptrend in the last 2 years or in the last 5 years? Those are great time frames to look at, and if you really want to be ultra safe, look at a 10-year time frame. And within those growth rates, it could be 20-30%, it could be 1 or 2%, right? What's a good growth rate? How do I know I'm picking a good stock based off of this checklist? Well, again, I go back to the valuation methodology here. I would say especially compared to its peer group or its sector. Next, has the company been growing its market share over time? This is a great example right here comparing AMD versus Intel. Now, because Intel is losing market share over time, its stock price has also deteriorated, while AMD's stock price has multiplied over 5-fold. If a company is losing market share, it's losing leadership, it's losing sales, it's losing income. After that, I like to consider the total addressable market, the TAM, for this particular company. Is the company's total addressable market increasing over time? If we look at the digital advertising sector, people expect it to grow by double digits for the next 5 to 10 years. That's an example of the TAM growing. Make sure that a company is investing or reinvesting its profits into a growth area. That brings me to my last point here on diversification and other housekeeping rules to know when it comes to the investing checklist. Even if your portfolio is very small, like maybe $500 or $1,000, I would say don't necessarily invest it all in one stock. There's always the off chance it could drop 50% and you're out of a lot of money. Now, if you're a young person targeting a lot of growth, maybe you will still have most of your portfolio in technology. But I would say still consider covering your bases by owning some bank stocks or owning some utilities or consumer staples, because that'll help round out your portfolio and help you manage volatility better. Ask yourself, will you have a balanced allocation of stocks, including options? Make sure that you're not all investing into one company, because if you're buying stocks and options into that company, that's still the same company. That's still the same investment, basically. Number 3, ask yourself, are you majority investing into large cap stocks and ETFs? If you are, that's generally where you want to be for a long-term investing portfolio. If you're investing into solely single stocks, which, by the way, does carry a larger risk than ETFs. For those retirement funds, maybe the QQQ or the SPY, the VUG you may have heard of, right? Those are already diversified funds which may have hundreds of different stocks within them. And if you're not investing into large cap stocks, you're kind of focused into small cap stocks, I generally see those as having a bigger risk. So try not to overload your portfolio with only small cap stocks or penny stocks. So that's it with the Stock Dads investing checklist, guys. I want to end this by saying that if you don't have to have stock or a company fit every single one of those checklist items, but if you answered for the valuation portion that your stock the valuation, the PE ratio, the forward PE ratio, etc., is all higher than every single other stock out there. And if you answered no, it doesn't have an uptrend in its revenue or net income, it doesn't have a good balance sheet, if your answers are majority to the negative for this checklist, you probably don't want to invest into that particular stock or fund. On the flip side, if you answer to the affirmative for the majority of these questions in this checklist, then I think you're in a pretty good investment. And no matter how good you think your investment is, always, always, always make sure that you're investing with money you can afford to lose. Comment down below if you end up using this checklist and tell me which stocks that you're looking to invest in right now. Check out our Discord group where we have live trading, a whole academy of videos, discussions, and alerts when we buy and sell different stocks. And I'll see you in the next video.